Hey traders, welcome back to the J brand. In this video, I'm breaking down market structure in just 10 minutes or even less than 10 minutes. It will be simple, clear and straight to the point. Whether you are new to trading or just need a solid refresher, this is the foundation you can't afford to skip. Let's dive right in. Alright, simple and clear, I'm going to be giving us two templates that symbolizes the same thing. I'm just going to be using these two templates to explain both the external market structure and the internal market structure. In every market structure, we always have externals and internals. The externals are majorly used for targets, while the internals are used as liquidity or inducement to fuel the movement of price to break every externals. This is the foundation of every market structure. You have to understand where the external is and you have to differentiate them from the internals. Okay, now pay close attention to my diagram. This is the first template. If you understand market structure in this format, I'm pretty sure it will help your trading psychology and also help you make your first $1,000 in the Forex market. So we have this as our first external, which is the break of structure, you see, as the target. Then we have this as our second external, which is a break of another structure. Then we have these strong lows as our protected area. Now, this is a simple textbook format. This is a simple template, okay, that you see on textbooks. But the market does not always present itself to you like this. In the real life trading scenario, the market presents itself with variations. Okay, it gives you the externals, but in a variation or with different variations. So it is your duty as a trader to understand the stories in the different variations that the market is presenting to you. Now let me give you another structure in form of variations. This is a simple structure. You can see the higher high, higher low, higher high, higher low, higher high, higher low. I want to present this same format in another way. This is it. We want to have something like this. Like I said before, we have external structures and we have internal structures. We are more interested in the external structures because the external structures gives us a clear direction of what price is doing. We are really not interested in those internal structures because they are used as liquidity to fuel price movement. We want to have something like this. Let me continue from here. All right. Now let's look at this. It's very simple looking at it. Okay, we can see the higher high, higher low, higher high, higher low, high, another higher high. There is no difference between this presentation, which is this first template, and this second template. Meanwhile, the market will always present itself in a confusing manner to traders. So it is your own duty to understand the exact story that the market is telling. The market tells a story gives you a clue before performing any action. So it is your own duty as a trader to understand the story that the market. This is the first target here. You're only interested in something like this. You're only interested in this. And this is the second break of structure. This is the second break of structure. This becomes our swing low, which can be said to be our protected area. So there is no major difference between this and this. This only presents itself with variations. Okay, we have this, you can see this higher, lower low, lower high, lower low, lower high, and then price gets to this demand area and then takes it up again. So if that is why it is important for you to understand structure from the higher time frame, because when you go to this is the lower time frame that is delivering price to the higher time frame. The lower time frame delivers price to the higher time frame. So you are more interested in the direction of the higher time frame. Okay, now in the lower time frame we can see diverse internal structures. Okay, and you see price using them as liquidity to fuel its movements back to its original direction. Okay, now let's take a look at these two examples that I've given. There's no difference between this and this. Of course, you know, this is a straightforward answer, while this is still the same answer but not straightforward. Let's take a chart example and then I believe we'll get a clearer picture. All right. Let me mark my structure from, we can see this. Please pay close attention to this example I'm taking. Then we can see the break of structure. The break of structure here, right? This is our externals. We are marking out our externals. We can have this line here, and then we have this here. It is always advisable to head straight to the higher time frame or start your analysis from the higher time frame so that you get a better picture of, you know, market direction. Now when we scale down to the lower time frame, we'll start seeing all these internals. We'll start seeing all these internals as major structures, but they are not major structures. Price is definitely going to use them as inducement to fuel its movement back to its original direction. Now let's take this example. So now what we are expecting, we are only expecting that price retraces itself back into this area, clearing out all the internals. Okay, clearing out all the internals and then continue to its original direction. So we have our first external here, and this is our next target. This is our next target. This is our next target. So our next, we are always using our target as our take profit. Okay, we are always going to be using our target as our take profit. So this is a simple, I think this video will really do you good if you take time to watch it and then understand the concept. Now people trade from the 15 minutes time frame. People trade from the 15 minutes time frame. In the 15 minutes time frame, we can see different kinds of movements. You are not interested in movements like this. I don't even want to come to this 15 minutes time frame because sometimes it might get traders confused when you don't understand what the higher time frame is doing. Okay, now let's play price and see how this works or how this plays out. We can see price creating different variations of lower high and lower low. Right now, there we go. When you scale to the 15 minutes time frame or 30 minutes time frame to check this bearish movement, this recent or just a temporary bearish movement, it's temporary, okay? It will not continue for long because price is in an uptrend, okay? And then some traders confuse this move to be a downtrend, okay? Price will definitely come to this discount area, mitigate an area of value. Price will definitely come to this discount area, mitigate an area of value, and bounce back to its original direction. Now let's see what happened. Are we saying price is changing direction? And then some unaware traders will be caught up in this trap, thinking markets is probably going to retrace and then come back down. These are factors you really need to understand. When you start your analysis from the higher time frame, it gives you a better direction of what the market is doing. So however the price moves, we understand that this is the next target of our price. That price will definitely come to break that next target. Can we see that? Can we see that, right? So price will definitely come to break that next target. Okay, so you are not interested in those internal structures because the internal structures are simply used as liquidity to fuel the move of price to break. Yes, there we go. We see that price has broken this next target. Price has broken this next target. So what happened here? We saw how price came. Price came, okay, trended down, created this series of highs and lows, came to this area, okay, taking out all these internal structures. Price took out all these internal structures, used them as liquidity, used all these structures or these internals as liquidity to fuel its price back to the upside. These are the variations I showed us in that diagram. Okay, these are the different variations that you don't have to get confused about. You just have to understand the external, know the next target, know your protected area, and stop getting trapped in all these internal structures. You really don't need it, but you only need internals to understand liquidity. So guys, if you found this video helpful, don't forget to like, subscribe, and drop a comment if you've got questions or video requests. This is the J Brand, where real traders grow with real knowledge. Catch you in the next one.